Welcome to the Deep Dive. Today we're going to be looking at some pretty interesting stuff from a corporate finance textbook.
Oh, yeah.
We're talking stock valuation, mergers and acquisitions, corporate governance, and even how companies manage risk.
Really, the whole picture of how companies handle money and make decisions about the future.
Exactly. So if you want to understand how Wall Street thinks about businesses, this is the deep dive for you.
That's right.
So let's start with maybe the most fundamental question of all. How do you figure out what a company is actually worth? What is its stock actually worth?
Yeah, that's a great place to start.
Yeah.
And there are, a bunch of models that analysts use to try to figure that out.
Okay.
One of the classic ones is called the dividend discount model.
The dividend discount model.
Yeah.
It sounds kind of straightforward.
Yeah, it's pretty intuitive.
You're looking at how much the company is paying out in dividends, right?
Yeah, basically the idea is that you can value a stock by figuring out what its future dividends are going to be.
Okay.
So you can imagine, okay, I'm holding the stock for a year.
Right.
I'm going to get some dividends during that year, and then at the end of the year, I can sell it to someone else.
Okay.
And so the model says that the price of the stock today should be equal to the present value of all those future cash flows.
Okay, so if a company is paying out like really great dividends consistently, then theoretically its stock price should be higher today.
Exactly.
Yeah. Okay, that makes sense.
Yeah.
But how do you actually go about predicting those future dividends? Is it really that simple?
Well, you've hit on maybe the biggest limitation of the dividend discount model is that it assumes that the company is going to have this nice, steady, constant growth rate of dividends, which is rarely the case in the real world.
Right.
So, you think about a company like Tesla. They've been, plowing all their profits back into growth. They haven't paid much in dividends. So this model wouldn't be very useful for valuing a company like Tesla.
Okay, so it's more of a starting point than an actual crystal ball.
Exactly. And it's important to remember that no single valuation model is going to be perfect.
Right.
Each one has its own strengths and weaknesses, and analysts often use a combination of different models to try to get a more complete picture.
Gotcha. Well, now, what about those investors who bet against a stock? What are they doing? It's not the dividend discount model, is it?
No. They're using a strategy called short selling.
Okay.
Which is basically the reverse of traditional investing.
So instead of buying low and selling high, they're doing the opposite.
Doing the opposite.
You're borrowing shares of a stock that you think is going to go down in price. You sell those borrowed shares, and then later on you buy them back at hopefully a lower price to return them to whoever you borrowed them from.
So if you're right and the price drops, you pocket the difference.
Yeah.
But if you're wrong, the price goes up, you could lose a lot of money. Absolutely. Short selling is a very high risk, high reward kind of strategy.
Yeah, for sure. Remember the collapse of Washington Mutual back in 2008?
Oh, yeah.
That was a big example of short sellers who saw the warning signs that everyone else missed.
Yeah, they correctly predicted that bank was going to fail.
Yeah.
And made a lot of money from it.
High risk, high reward.
Yeah.
Okay. Let's switch to a different model, the total payout model. What is that?
Sure. So the total payout model recognizes that companies can return value to their shareholders in two ways. They can pay dividends, and they can repurchase their own shares.
Okay, so share repurchases.
Yeah.
Just to remind me. So the company buys back its own shares, so it reduces the number of shares that are out there.
Yeah.
And that means the remaining shares should be more valuable.
Exactly. It's like if you have a pie and you cut it into fewer slices, each slice becomes bigger.
Okay.
So the total payout model gives you a more complete picture of how a company is rewarding its shareholders.
Right. It's not just about that dividend yield.
Exactly. And, a company like Home Depot has been very aggressive in buying back its shares. And that's been a big driver of their stock price growth, even though their dividend yield isn't particularly high.
Gotcha. Okay, so we've looked at models that are based on dividends and payouts, but what about companies that aren't really focused on either of those? How do you value those kinds of companies?
Yeah, so that's where the discounted free cash flow model comes in.
Okay.
So this model focuses on the cash that the company generates that's available to all investors.
Okay.
Both debt holders and equity holders.
That free cash flow is like the lifeblood of any business.
Exactly. It's the cash that's left over after they've paid all their bills and made all their investments.
Right.
So this model is especially useful for valuing companies that aren't paying dividends, or for companies where the dividend payments don't really reflect their true earnings potential.
Right.
Like take Amazon, for example.
Mm.
They were reinvesting heavily in growth for years, so their dividends were tiny, but their free cash flow was enormous.
Yeah.
And that's really what drove their valuation.
Okay, but it seems like this model relies on making a lot of assumptions about the future.
Yeah, you're right. It's not an exact science.
Yeah.
Analysts have to make some educated guesses about future revenue growth, profit margins, things like that.
Right.
And those assumptions can have a big impact on what the estimated value is.
Okay. Yeah. It's starting to seem like this valuation thing is a little more complicated than I thought.
It definitely can be.
Yeah. Okay, so we've got the dividend discount model,
Mhm.
we've got short selling, we've got the total payout model, and now the discounted free cash flow model.
Mhm.
Plus, you mentioned using comparable companies.
Yeah, that's right.
So what's that about?
So that's often called the method of comps.
Okay.
And the idea is that you look at other similar companies in the same industry
Hmm.
and you compare their valuation multiples.
Okay, so if company A is trading at a certain multiple, then company B, which is similar, should also be trading around that same multiple.
Yeah, basically. But you have to keep in mind that no two companies are exactly alike.
Sure.
So you have to adjust those multiples to account for any differences between the companies,
Okay.
such as their growth rates, their debt levels.
And how good their management is.
Exactly.
Yeah, okay. So it's a helpful tool, but it's not the be-all, end-all.
Right.
Okay.
It's more like using a map to navigate a city.
Mm-hmm.
It can give you a general sense of where things are, but you still have to pay attention to the specific streets and landmarks.
Right. So you need to look at each business individually.
Exactly.
Okay. So we've got those 4 valuation methods we've got using comps. But now let's move from how companies are valued to how investors actually behave in the market.
Okay.
Because I think we all know that the market isn't always perfectly rational.
Not at all. In fact, investor behavior can be a very powerful and unpredictable force.
Right.
It can really move stock prices around.
Yeah. So how do those human emotions play out in the market?
Well, this is where we get into this field called behavioral finance.
Okay.
And one of the key ideas in this field is called the efficient markets hypothesis,
Okay.
which basically says that stock prices already reflect all the available information out there,
Okay.
which makes it extremely difficult to consistently beat the market.
So if that's true, it means trying to pick winning stocks is essentially just a game of chance.
Well, not quite.
Okay.
The reality is a bit more nuanced.
Okay.
While it is true that information does travel very quickly in today's world,
Right.
there are always going to be some pockets of inefficiency, and skilled investors can sometimes exploit those.
So it's not impossible to outperform the market.
Right.
It's just really hard.
It's much harder than many people think.
Yeah. Okay. But even if all the information were instantly available, investors aren't always rational.
Oh, absolutely.
Yeah.
We're all susceptible to biases that can cloud our judgment.
So what are some of those biases that can trip up investors?
Well, one of the most common ones is overconfidence.
Okay.
Investors tend to overestimate their own abilities and how accurate their information is.
Right.
This leads them to trade too often. They rack up trading costs.
Yeah.
And they might miss out on those long-term gains.
Yeah, they're jumping in and out of stocks based on gut feelings or headlines rather than doing careful research.
Exactly. It's like they're trying to time the market, which almost never works.
Almost never, yeah. Okay, so patience is key.
It is.
What about other biases?
Another one is called framing,
Okay.
which refers to how information is presented.
Okay.
So, a news headline that screams, company X profits plummet might trigger some fear and panic selling.
Even if the company is actually still doing well overall.
Exactly.
So it's all about perspective.
Right.
Okay, what about mental accounting?
Oh, yeah, that's another interesting one.
Tell me about that.
So mental accounting is when investors treat different pockets of money differently. So they might be more willing to gamble with profits from a recent stock sale
Okay.
than with money they've been saving for years.
Right.
Even though it's all part of their overall portfolio.
Yeah, it's like they're playing with house money when it comes to winnings.
Exactly.
Yeah, which can lead to some pretty risky behavior.
Right.
Okay, well, these behavioral biases are really interesting because it shows how psychology can impact our financial decisions.
Yeah, it's a fascinating field.
Yeah. So how does information actually play out in the market? Because at the end of the day, stock prices are driven by what investors know or think they know, right?
That's right. Information is the fuel that makes the market go.
Right.
Stock prices move based on news, earnings reports, economic data, all sorts of things, even rumors.
So if a company announces amazing earnings,
Yeah.
the stock price should go up.
Right.
But how quickly does that actually happen?
Well, in today's world, information spreads incredibly fast.
Yeah.
So publicly available information that's easy to understand, like a company's earnings report, that stuff is often priced in almost instantly.
So by the time I hear about it on the news, it's too late to profit.
Probably. Yeah, those high-frequency trading algorithms, they can react in milliseconds to new information.
Right.
So it's tough for individual investors to beat them to the punch.
Yeah, okay, but what about information that's not public, like what you might call private or insider information?
Yeah. So that's where things get a little more interesting.
Okay.
Public information is available to everyone, but private information is much harder to come by.
Right.
It often requires deep industry knowledge or specialized research.
Okay, so it's the difference between, like, reading a newspaper article about a company
Yeah.
and having a private conversation with one of their executives.
Exactly. And, it's important to note that insider trading,
Yeah.
which is using non-public information to profit from trades,
Right.
that's illegal.
That's illegal. Yeah.
Can land you in big trouble.
Yeah. But there are legal ways to gain insights that others might miss through careful research and analysis, right?
Yeah.
So can you give me an example of how information, both public and private, can actually move stock prices?
Sure. So imagine a hypothetical biotech company
Okay.
that's waiting for FDA approval for a groundbreaking new drug.
All right.
Let's say there's a 50-50 chance of approval.
Yeah.
What do you think happens to the stock price leading up to that announcement?
I imagine there's a lot of speculation,
Yeah,
volatility.
exactly.
Some investors are betting on approval, and some are worried about rejection.
Right. And the stock price is going to reflect those different views.
Okay.
It'll fluctuate as rumors and news snippets come out.
Okay. And then when the FDA announces their decision, if the drug's approved,
Yeah.
the stock price probably jumps up.
Right.
But if it's rejected,
Yeah.
wouldn't it plummet?
Yeah, it would probably drop. But here's the interesting part.
Okay.
Even if the drug is rejected, the stock might not completely collapse.
Okay.
Because investors are going to start digging into the details of the FDA's decision. Were there safety concerns?
Right.
Were the clinical trial results not convincing enough?
Okay. So they're trying to understand why the FDA made the decision they did.
Exactly. And this is where that private information can come into play.
Okay.
So investors with deep industry knowledge or access to expert analysis,
Yeah.
they might be able to glean insights that other people miss.
So they're one step ahead of the crowd.
Precisely. And this just highlights how important it is to stay informed and do your homework.
Right.
Knowledge is power in investing.
That's true. That's true. Okay. So we've seen how information flows through the market and how it affects stock prices.
Mm-hmm.
Now let's turn our attention to mergers and acquisitions, or M&A as the cool kids call it.
Right.
Why do companies decide to join forces?
M&A is an exciting area of corporate finance.
Yeah.
It's all about companies combining to create something bigger, hopefully better and more valuable.
Right.
But the reasons behind these deals can be complicated.
Yeah.
They can range from strategic synergies
Yeah.
to, financial engineering.
Yeah. But sometimes, let's face it, plain old ego.
Some CEOs just love to build their empire. Right.
You got it.
Okay, so let's start with maybe the more strategic reasons for mergers.
Okay.
What are those?
So one of the most common motivations is to achieve synergies,
Okay.
which basically means cost savings or revenue enhancements that come from combining two companies.
So it's about being more efficient or reaching a bigger market.
Exactly.
Can you give me an example of a merger that was really driven by those synergies?
Sure. The merger of Disney and Pixar.
Okay.
That's a classic example.
Mm-hmm.
Disney wanted to strengthen its animation capabilities.
Yeah.
And Pixar had this incredible track record of creating hit movies.
Right.
So by joining forces, they were able to leverage each other's strengths,
Okay.
create this powerhouse animation studio.
1 + 1 = 3.
Exactly.
Yeah, okay. But I imagine those synergies aren't always so easy to achieve.
Yeah, you're right. Sometimes mergers fail to deliver those promised cost savings or that extra revenue growth.
And the combined company ends up being less valuable than the two separate companies were.
Yeah, it happens. Okay, well, what about diversification? Why might a company try to diversify through mergers and acquisitions?
So diversification is all about reducing risk
Okay.
by spreading your bets across different industries or product lines.
Right.
So think about a company that's really reliant on just one product or one market.
Okay.
If that product becomes obsolete
Yeah.
or that market shrinks,
They're in trouble.
they could be in big trouble.
Yeah. Okay. So by acquiring companies in different industries, they're hedging their bets.
Exactly. They're creating a more balanced portfolio,
Yeah.
which can help them weather economic storms.
Okay. Like General Electric, right?
Yeah, GE is a classic example of a conglomerate.
They've got their fingers in every pie.
They do. They've got businesses in everything from aviation to healthcare to finance.
Yeah. Okay. But I'm guessing diversification can be taken too far.
Oh, yeah, absolutely. There's
Yeah.
a balance. If a company gets too big and too complex, it can be really difficult to manage effectively.
Right. Remember that infamous Time Warner AOL merger back in 2000?
Oh, yeah, that was a classic example of diversification gone wrong.
Yeah.
The dot-com bubble was in full swing, and Time Warner thought merging with AOL would launch them into the digital age.
But the cultures didn't mesh.
No, they clashed.
Yeah. And they never really achieved those synergies they were hoping for.
Nope.
And it ended up costing shareholders a lot of money.
It did billions of dollars.
Yeah. Okay. Well, so we've talked about synergies and diversification, but sometimes the driving force behind a merger is just pure ego.
Yeah, you got it.
Yeah.
Some CEOs just get caught up in the deal-making frenzy, and they prioritize growth over shareholder value.
So they end up overpaying for acquisitions or taking on too much debt.
Yeah, or making rash decisions just to boost their own status.
Right. So investors need to be aware of this potential bias and look carefully at why a merger is happening.
Don't just assume that bigger is always better.
Don't assume that, yeah.
Yeah.
Okay, so let's move from the why of mergers to the how.
Okay.
What are the actual steps involved in a merger?
So it's a multi-stage process, often involving intense negotiations, due diligence, regulatory approvals, and then finally the integration of the two companies.
It's a lot.
It can be very complex and time-consuming, and not all deals make it to the finish line.
Okay, so how does it typically get started?
Usually it starts with a company called the bidder, making an offer to acquire another company called the target.
Okay.
And that offer can be friendly, meaning the target company's board of directors is open to the deal.
Right.
Or it can be hostile,
Okay.
meaning the target company's board resists the takeover attempt.
So it's like a corporate courtship.
Yeah.
But sometimes it turns into a hostile takeover.
Yeah.
Okay, and things can get pretty intense in those situations.
Oh, absolutely.
Yeah.
There can be proxy fights, legal battles.
It's a real battle.
It can be.
Yeah. Okay, well, let's say the two sides have agreed to a deal. What happens then?
Then comes the due diligence phase.
Due diligence.
Where both sides carefully examine each other's financials, operations, legal documents.
Okay, so they're doing their homework.
Exactly.
Yeah.
It's like inspecting a house before you buy it.
You don't want any surprises.
You don't.
Okay, so if everything checks out during due diligence, what's next?
Well, if both sides are still happy with the deal,
Okay.
they move on to negotiating the final merger agreement.
Cool. So they hammer out all the details,
Precisely.
like the purchase price, how they're going to pay for it, cash, stock, or
Yeah,
combination.
And any other conditions of the deal.
Okay, and once they've signed that merger agreement, then they need to get approval from regulators, right?
That's right. Usually they need to get antitrust clearance from government agencies.
So the government's making sure the merger doesn't stifle competition.
Exactly.
Okay. And if they get the green light from the regulators, then the deal can finally close.
Yep. And the two companies become one.
And they all lived happily ever after.
Well, not always.
Wow.
Merging two companies is more than just signing some papers.
It's not that easy.
It's not. It's about bringing together two different cultures, two different systems, two different workforces.
Right. So it's about making a cohesive whole out of these two separate parts.
Exactly.
Okay. And that's got to be a delicate process.
It is. And unfortunately, many mergers fail to reach their full potential.
Yeah.
Because the integration is poorly planned or executed.
So you need a clear vision for that combined company.
Yeah.
And a solid plan for bringing those two organizations together.
You got it.
Okay, so we've talked about the what and the why and the how of mergers. But let's talk about a specific type of acquisition that's become really popular lately.
Oh, yeah.
Leveraged buyouts.
Or LBOs.
LBOs. So those are the ones that are often associated with private equity firms, right?
Yeah, exactly.
Okay.
So private equity firms use a combination of debt and equity financing to acquire companies, often taking them private.
Okay, so they're borrowing money to make these big acquisitions.
That's right.
That sounds risky.
It can be the high levels of debt involved in LBOs
Yeah.
can amplify both the gains and the losses.
So if the acquired company does well,
Yeah.
the private equity firm makes a lot of money.
They can make a fortune.
Yeah.
But if the company struggles,
Mm-hmm.
the debt can become really unsustainable and even lead to bankruptcy.
Okay, so give me an example of a really successful LBO.
Okay, well, one of the most successful LBOs in history was the acquisition of RJR Nabisco
Yeah.
by a firm called KKR back in the 1980s.
Okay.
KKR was able to turn around that struggling food and tobacco giant.
Yeah.
Eventually, they took it public again and made huge profits for themselves and their investors.
Okay, so that was a legendary LBO.
It was.
What about one that didn't go so well?
Well, the LBO of TXU,
Yeah.
a Texas utility company back in 2007,
Mm-hmm.
that's often cited as a cautionary tale.
Okay.
The private equity firms that bought TXU loaded it up with debt, just as the energy market was about to tank.
Oh, no.
Yeah, the company ended up filing for bankruptcy.
And the private equity firms lost a ton of money.
They lost billions.
Wow. Okay, so LBOs, they're not for the faint of heart.
Definitely not.
Yeah. Okay, well, we've covered a lot of ground with M&A.
We have.
Let's switch gears and talk about corporate governance.
Okay.
Because this is all about making sure a company is run ethically and in the best interest of its shareholders.
Exactly. It's about transparency, accountability, responsible decision-making.
But without good governance, things can really go off the rails.
They can think about Enron and WorldCom.
Yeah, their collapses were fueled by accounting fraud and a total lack of oversight.
Exactly.
Okay, so what are the key ingredients of good corporate governance?
So one of the most important things is a strong and independent board of directors.
Okay.
The board's job is to oversee management set strategy and protect shareholder interests.
But sometimes those boards can get too cozy with management, can't they?
Yeah, unfortunately, that's called board capture.
Board capture.
And it can really undermine the whole system.
Okay, so you need independent directors who aren't afraid to challenge management.
Absolutely.
Okay, what about executive compensation?
Yeah, executive compensation.
Tricky subject.
It's a delicate balance.
Yeah, because you want to align managerial incentives with shareholder goals.
Right.
But if those executives are getting paid exorbitant sums,
Yeah.
regardless of how the company actually performs,
Mm-hmm.
that can create a real conflict of interest.
You got it.
Yeah. So how do you strike that right balance?
So it's all about creating compensation structures that reward long-term value creation
Okay.
while discouraging excessive risk-taking
Right?
or short-term thinking.
Yeah, but what happens if things go wrong?
Okay.
Like if shareholders think a company's being mismanaged?
So shareholders have a few different ways to make their voices heard.
Okay.
They can submit proposals,
Okay.
they can engage in what's called shareholder activism,
Okay.
or they can even launch proxy contests to try to replace board members.
Proxy contests.
Yeah.
Those sound kind of dramatic.
It can be. It's essentially a battle for control of the company.
Oh.
One of the most famous proxy fights was Carl Icahn's battle with Yahoo back in 2008.
Oh, yeah. Icahn was a big shareholder,
He was.
and he wanted to oust the CEO.
Exactly.
Okay, so those proxy fights are a powerful tool for shareholders.
They are.
Okay, so it's not just about following rules and regulations.
Right.
It's about creating a culture of ethics and transparency.
It is.
Okay, well, let's move on to our final topic.
Okay.
Risk management.
All right.
Every business faces risks.
Oh, yeah.
Everything from economic downturns
Mm-hmm.
to natural disasters to cyber attacks.
That's right.
So how do companies identify and assess and manage all those risks?
So risk management is a really important part of corporate finance.
Yeah.
But it's often overlooked.
Okay.
It's about proactively identifying potential threats,
Yeah.
evaluating their impact, and developing strategies to mitigate those risks.
So it's about being prepared, because if you don't manage risk effectively, there can be serious consequences.
There can.
Think about the 2008 financial crisis.
Oh, yeah. A lot of companies failed to adequately assess and manage their risk exposure.
Right.
And that led to widespread financial distress and even bankruptcies.
So what are some of the tools and techniques that companies use to manage risk?
Well, one of the most common is insurance.
Okay.
Companies can buy insurance policies to protect themselves against a variety of risks.
Property damage liability claims, business interruptions.
All sorts of things.
Okay, so insurance is like a safety net.
It is.
What else can companies do?
Sometimes they need to use other techniques like hedging with derivatives.
Derivatives.
Yeah.
Those sound complicated.
They can be, but basically derivatives are contracts
Okay.
that derive their value from some underlying asset,
Okay.
and they can be used to manage all sorts of risks.
Like What kind of risks?
Interest rate risk, currency risk, commodity price risk.
Okay, so let's take those one by one. How does a company hedge against interest rate risk?
So imagine a company that's borrowed money at a variable interest rate. If
Right.
interest rates go up.
Their borrowing costs go up.
Exactly. And that can eat into their profits.
So they're exposed to the risk of those rising interest rates.
They are.
Okay.
So to hedge against that risk, they might use something called an interest rate swap.
An interest rate swap.
Yeah.
What is that?
It's a contract that allows them to exchange their variable interest rate payments for fixed rate payments.
Okay, so they're essentially locking in a fixed interest rate.
Exactly.
Oh, okay.
It's like buying insurance against rising interest rates.
That's a good analogy. Okay, now what about currency risk?
So for companies that do business internationally,
Mm-hmm.
their revenues and expenses are affected by changes in exchange rates.
Okay.
So if the dollar weakens,
Yeah.
their foreign earnings will be worth less when they convert them back into dollars.
Right, so that's the risk.
Exactly.
Okay.
To hedge against that risk, they might use currency forwards, which are contracts that lock in an exchange rate for a future transaction.
So they're agreeing to buy or sell a certain amount of currency at a specific price on a specific date.
Exactly.
Okay, so that protects them from unexpected currency fluctuations.
Yeah, it helps them plan their finances more effectively.
Okay, and what about commodity price risk?
So let's say a company needs a certain commodity,
Okay.
like oil or copper, to make their products.
Okay.
If the price of that commodity spikes,
Mhm.
their costs go up and their profits get squeezed.
Yeah.
So to hedge against that risk, they might use futures contracts,
Futures contract.
which are agreements to buy or sell a specific amount of the commodity,
Huh.
host speaker, at a fixed price on a future date.
So they're basically locking in a price for that commodity,
Yeah.
protecting themselves against future price increases,
Right. It helps them manage their input costs.
and makes their business more predictable.
Exactly.
Okay, so we've talked about insurance, interest rate swaps, currency forwards, and futures contracts.
Mhm.
It sounds like companies have a whole arsenal of tools to manage risk,
They do.
but choosing the right tools
Right.
is probably the tricky part.
It is. There's no one-size-fits-all solution.
Yeah, it's about tailoring the strategy to each company's situation and their goals.
Exactly. And it's an ongoing process.
Yeah.
Companies have to constantly monitor their risk exposure,
Okay.
adjust their strategies, and be ready to adapt to changing market conditions.
So risk management is more than just avoiding losses.
Right.
It's about balancing risk and reward to try to create value over the long term.
Absolutely. Well said. And it's a crucial part of corporate finance,
Yeah.
even if it doesn't always get as much attention as some of the other topics we've discussed.
Yeah, okay, so last time we were talking about how companies manage risk,
Right.
but let's dig a little deeper into some of the nuances of those decisions, because they're not always as simple as they might seem.
Yeah, the real world is full of complexities
Yeah.
that can make these choices a lot trickier.
So what are some of those real-world wrinkles that companies need to think about?
Well, one thing is taxes.
Okay.
You know, if a company can deduct insurance premiums as an expense,
Right.
that makes insurance more attractive.
Uh-huh.
But some hedging strategies might create taxable gains,
Right.
which could reduce their effectiveness.
So it's not just about the mechanics of the hedge.
Right.
You also have to consider the tax implications.
Exactly. And then there's the potential cost of financial distress.
Okay.
Imagine a company gets hit with a huge unexpected loss.
Yeah.
They might have to raise capital quickly on really unfavorable terms just to stay afloat.
Okay.
And that can be really costly.
So insurance or hedging could help them weather those storms.
Yeah, it could act as a buffer.
Okay.
But even then, the decision depends on how financially healthy the company is.
Right. A company that's already drowning in debt
Yeah,
might not be able to afford those extra layers of protection.
it's like they're already playing defense.
I like that analogy. Yeah. Okay, and then there's the issue of managerial incentives.
Right.
We talked about how executives sometimes have their own interests at heart,
Yeah,
which might not align with what's best for the shareholders.
that's right.
So how does this play out in risk management?
So imagine a CEO whose compensation is heavily tied to stock options.
Okay.
They might be reluctant to hedge against a potential drop in the stock price.
Even if it's the right thing to do for the company.
Yeah, because if the stock goes up, they want to maximize their own gains.
Okay, so their personal interests could override the company's need to manage risk wisely.
Yeah, that's why good corporate governance is so important.
Yeah, it's about having those checks and balances.
Right.
Okay, I'm starting to see how tangled all these risk management decisions can be.
It's not just about numbers on a spreadsheet.
Yeah.
You have to understand the company's financial position,
Right.
the incentives that are at play.
And the big picture of what's happening in the market.
You got it.
So effective risk management requires both that financial savvy and a deep understanding of what's going on inside the company.
Absolutely.
Okay, well, this brings up an interesting question.
Okay.
How do you think companies are going to approach risk management in the future?
Especially with all the uncertainty in the global economy
Right.
and the rapid pace of technological change.
Yeah, what trends are on the horizon that could reshape how companies think about risk?
Well, I think data analytics and technology are going to play an even bigger role.
Oh, yeah.
Companies are already using sophisticated models
Mm-hmm.
to try to quantify different risks and assess their potential impact.
Right. They need to move beyond just gut feelings
Yeah,
and get more precise in their understanding of what could go wrong.
exactly. And as artificial intelligence and machine learning advance,
Yeah.
companies will be able to analyze even more data
Okay.
and potentially spot patterns that humans would miss.
So they can anticipate risks before they even happen.
That's the idea.
Okay, so instead of reacting to events after the fact,
Yeah,
companies can become more proactive and resilient.
exactly. But there's another trend that's making risk management even tougher,
Okay.
and that's the rise of new and interconnected risks.
Yeah, okay.
Think about climate change, cybersecurity threats, geopolitical instability.
Yeah, these are complex, multifaceted risks.
AR.
It don't fit neatly into any one category.
Right.
So how do you manage risks that are constantly changing and interconnected?
It's not easy.
It's not like just buying an insurance policy.
No, it's not.
Right.
Companies need to adopt a more holistic and integrated approach to risk management.
Okay, so it becomes a company-wide effort.
Yeah, breaking down those traditional silos
Yep.
and encouraging collaboration across different departments.
So the legal team, the operations team, the finance team, even the marketing team, they all need to be thinking about risk.
Yeah, it becomes part of the company's DNA ingrained in its culture.
Okay, and this brings us back to the human element,
Right.
which I think is often overlooked.
It is.
Because even with all the fancy technology and data,
Yeah.
at the end of the day, it's still people making those decisions.
It is judgment, experience, intuition.
Those things still matter.
They do. Because you can't model everything.
You can't predict every black swan event.
Nope.
So companies need leaders who can think critically, adapt quickly, and make tough calls under pressure.
They do.
They need to cultivate that risk-aware culture
Absolutely.
where everyone's thinking about risk management.
It's not just the job of a specialized team.
Yeah, everyone needs to be involved.
Exactly.
Okay, well, we've talked about how complex these risk management decisions can be and some of the trends that are shaping the future of risk management.
Right.
Now, let's switch gears and talk about another important topic: capital budgeting.
Okay, sounds good.
Capital budgeting is all about making smart decisions about how to allocate a company's financial resources.
Yeah.
So it's about investing in projects that will generate the highest returns while also managing risk effectively. It's like a company's version of personal finance.
Yeah, it's about figuring out how to spend their money wisely.
But the stakes are a lot higher.
They are much higher.
We're talking millions, even billions of dollars.
Absolutely. These decisions can make or break a company.
Sure.
A good capital budgeting process can drive growth, innovation, and profitability.
But a bad one can lead to wasted resources.
Yeah, and missed
Yes.
opportunities.
So how do companies approach this crucial process?
Well, the first step is generating ideas.
Okay.
This involves identifying potential investment opportunities that align with the company's overall strategy and goals.
So they're looking for projects that fit with their big picture plan.
Exactly. And these ideas can come from anywhere.
Okay.
R&D, marketing operations, even employees on the front lines.
So they're encouraging creativity and innovation throughout the organization.
Exactly. The more diverse the range of ideas, the better.
Okay, but once they have a bunch of ideas, how do they decide which ones are worth pursuing?
That's where the next step comes in, analyzing those ideas. So this involves gathering data, estimating costs and revenues, and evaluating the potential risks and returns of each project.
So they're doing their homework.
Yeah, they're crunching the numbers to get a clear picture of whether the project makes financial sense.
Okay, and this often involves building detailed financial models.
Yeah, it does. They often do market research,
Right.
assess the competitive landscape.
It's a thorough process.
It is, but it's essential for making good decisions.
Right.
You don't want to pour millions of dollars into a project,
Yeah.
only to realize later that you underestimated the costs or overestimated the demand.
That's a recipe for disaster.
It is.
Okay, so they've analyzed all these potential projects.
Yeah.
Now, how do they actually decide which ones to fund?
Because they can't do everything right.
Right. Companies have limited resources.
They do. So the next step is making the decision.
Get it.
And this usually involves ranking the projects
Okay.
based on their expected return on investment, their risk profile, and how well they align with the company's strategic goals.
So it's about prioritizing the projects that offer the best combination of return and risk.
Exactly. And this decision-making process usually involves both quantitative analysis and qualitative judgment.
Right, because not everything can be captured in a spreadsheet.
You got it.
They have to consider things like brand reputation, customer relationships, even their social responsibility goals.
Exactly. It's about taking a holistic view
Okay.
and weighing all the potential benefits and risks.
And then once they've made a decision,
Right.
they move on to actually implementing the project.
That's right. This is where the rubber meets the road.
Yeah, turning the plan into action.
Exactly. Allocating resources, managing timelines, overseeing execution.
It's a big job.
It is.
Huh.
But effective capital budgeting is crucial for companies that want to grow, innovate, and create value.
Yeah.
It's the engine that powers their success.
So it's not just about picking the right projects. It's
Right.
about having a robust process
Mhm.
for evaluating opportunities, making decisions, and then managing those projects effectively. Okay, so we've outlined those key steps in capital budgeting.
Yeah.
Now let's dive into some of the specific techniques that companies use to actually evaluate these potential projects.
Okay.
One of the most common is net present value, or NPV.
Right.
Can you explain how that works?
Sure. So NPV is a really powerful tool that allows companies to compare the value of money today to the value of money in the future.
Okay.
It's based on this concept of discounting,
Discounting.
which basically means adjusting those future cash flows to reflect the time value of money.
Okay, the time value of money.
Yeah.
Just remind me how that works again.
Sure. So the time value of money is the idea that money today is worth more than the same amount of money in the future.
Because you can invest it and earn a return on it?
Exactly. $1 today is more valuable than $1 a year from now because you could put that dollar to work earning interest
Right.
or investing it in a project that generates a return.
Okay, so NPV takes that concept into account. So when you're evaluating a project, you're looking at the future cash flows that the project is expected to generate.
Right.
And then you discount those cash flows back to their present value
Yeah.
using a discount rate
Yeah.
that reflects the company's cost of capital.
Exactly.
And that cost of capital, that's basically the rate of return that a company needs to earn on its investments
Yeah.
to keep its investors happy.
Right. Because investors expect a certain return for providing their capital.
Okay, so you discount those future cash flows back to their present value using the cost of capital,
Mm-hmm.
and then what?
And then you subtract the initial investment cost of the project.
Okay.
And the result is the net present value, or NPV.
So if the NPV is positive,
Yeah.
it means the project is expected to generate a return that exceeds the company's cost of capital.
Exactly.
So that's good.
It is a positive. NPV means the project is worth doing.
And if it's negative,
A negative NPV means the project is expected to destroy value.
they're losing money.
Basically.
Yeah. Okay, so they should probably invest their money somewhere else.
Probably.
Okay, well, NPV sounds like a pretty useful tool for evaluating those potential projects.
It is.
But it's not the only technique, is it?
No, it's not.
What are some other approaches?
Another common one is the internal rate of return, or IRR.
The IRR?
Yeah.
I've heard that term, but I'm not sure I completely get it.
Okay, so the IRR is basically the discount rate that makes the NPV of a project equal to 0.
So it's the rate of return that the project is expected to generate?
Exactly.
Okay.
And if the IRR is higher than the company's cost of capital,
It means the project is a good investment.
it does. It means it's expected to create value.
Okay, so it's similar to NPV
It is.
in that it's comparing the project's expected return to the company's cost of capital.
Right.
But NPV gives you the dollar amount of value that the project is expected to create,
Yeah,
and IRR gives you the percentage return.
exactly.
Okay, so they're both helpful,
They are.
but they give you slightly different information.
They do. And companies often use both NPV and IRR, along with other techniques like payback period and profitability index.
To get a more well-rounded view
Exactly.
of the project's potential.
Right.
Okay, but remember, capital budgeting isn't an exact science.
Oh, no.
It's based on assumptions about the future,
Yeah.
which is inherently uncertain.
Very uncertain.
So companies need to be flexible and willing to adjust their course as needed.
Absolutely. The key is to have a good process for evaluating those opportunities, making informed decisions, and then managing the projects effectively.
Right, and that process should always be evolving based on experience and feedback.
You got it.
So it's a learning process.
That is.
Okay, well, we've explored those key steps in capital budgeting,
Mm-hmm.
the importance of NPV and IRR,
Right.
and the need for flexibility.
Right.
Now let's turn our attention to working capital management.
Okay.
Working capital management is all about managing those day-to-day financial operations of a company. It's about making sure the company has enough cash on hand to pay its bills,
Right.
while also maximizing the efficiency of its operations.
Exactly. It's like the nuts and bolts of running a business,
Wow.
making sure the cash is flowing smoothly.
So even if a company has a great long-term strategy,
Yeah.
if it can't manage its day-to-day finances,
Right.
it can run into trouble.
Big trouble.
Okay, so what are the key elements of working capital management?
So the three main components are accounts receivable,
Okay.
inventory, and accounts payable.
Okay, so accounts receivable is about collecting money from customers.
Yeah.
Inventory is about managing the flow of goods.
Mm-hmm.
And accounts payable is about paying suppliers.
Exactly.
Okay, so effective working capital management is about optimizing each of those components.
Right.
Making sure the company has enough cash on hand,
Yeah.
but also minimizing its costs and maximizing efficiency.
It's a balancing act.
Yeah, it is.
You don't want to be too aggressive in collecting from customers because you could damage relationships. Right.
But you also don't want to be too lenient and tie up cash that you need.
Okay, so it's about finding that sweet spot
It is.
that balances the needs of the business with the needs of its customers and suppliers.
Exactly.
Okay, let's talk about some techniques
Go ahead.
for managing accounts receivable.
Right.
What are some common approaches?
Well, one common technique is offering discounts for early payment.
Okay, so you incentivize customers to pay their bills sooner.
Yeah, and that frees up cash for the company.
Okay, what else can they do?
Another approach is setting clear credit terms and policies.
Okay.
So this involves things like vetting customers,
Hmm.
setting credit limits, and defining payment deadlines.
So it's about managing credit risk effectively.
Exactly. You don't want to extend credit to customers who aren't going to pay their bills.
Right.
And it's also important to have a system for monitoring outstanding invoices and following up with customers who are late.
Because the longer an invoice goes unpaid,
Yeah.
the less likely you are to collect. Precisely so, you need to be proactive.
Stay on top of it.
Exactly.
Okay, so we've talked about managing accounts receivable.
Mm-hmm.
Now let's talk about inventory.
Okay.
What are some key things to consider when you're trying to manage inventory effectively?
So the goal of inventory management is to minimize the cost of holding inventory
Okay.
while also making sure the company has enough inventory to meet customer demand.
Right, so is that balancing act again?
It is.
You don't want too much inventory sitting around
Yeah,
because that ties up cash and increases the risk of it becoming obsolete or spoiled.
right.
But you don't want to run out of inventory either
No, you don't.
because then you could lose sales and upset customers.
Exactly.
And the ideal level of inventory is probably different for every company in every industry, right?
It is. A grocery store is going to have different needs than a car manufacturer.
Okay, and even within the same industry,
Mm.
those inventory strategies might be different depending on the specific products,
Right.
their supply chain,
Yeah.
and their customers.
Exactly.
Okay, so how do companies figure out the right level of inventory?
What are some techniques they use? One common approach is called just-in-time inventory management,
Just in time.
or JIT for short.
JIT.
And this involves coordinating production with demand
Okay.
so that inventory arrives only when it's needed.
So they're not stockpiling inventory.
Right. They're relying on their suppliers to deliver goods just when they need them.
Okay, so that can help reduce inventory costs, minimize waste, and improve efficiency.
It can, but it requires close coordination with suppliers
Okay.
and a reliable supply chain.
Right, because if there's any disruption in the supply chain,
Yeah.
you could be in big trouble.
Exactly. So JIT isn't right for every company.
Gotcha.
It really depends on the situation.
Okay, well, besides JIT, what are some other techniques?
Another common one is called materials requirements planning,
Okay,
or MRP.
MRP.
And this involves using software to forecast demand,
Okay.
plan production, and manage inventory levels.
So it's more automated.
Yeah, they're using technology to optimize the whole process.
Okay. And that can help improve forecasting, reduce lead times, and minimize costs.
Exactly.
All right, so we've talked about accounts receivable and inventory. Now let's move on to accounts payable.
Okay.
What are the key things to keep in mind when you're managing accounts payable?
So the goal is to minimize the cost of paying your suppliers
Okay.
while also maintaining good relationships with them.
Right, you want to pay your bills on time,
Yeah,
but you also want to maximize your cash flow.
exactly. It's about finding that balance.
Yeah.
And it's about negotiating favorable payment terms with your suppliers,
Okay.
taking advantage of any early payment discounts, and managing your payment schedule effectively.
So it's about being strategic
Right.
and proactive.
Exactly.
And it's also about building strong relationships with those suppliers.
Yeah.
Because a good supplier can be a real asset. They give you insights,
Yeah.
support, even flexibility when you need it. Okay, so managing accounts payable is not just about saving money.
Right.
It's about building those win-win partnerships.
Exactly.
Okay, so we've looked at those three main components of working capital.
Yeah.
Accounts receivable, inventory, and accounts payable. And we've talked about some common techniques for managing each one effectively.
Right.
Now let's zoom out a little.
Okay.
How does working capital management fit into a company's overall financial strategy?
Well, working capital management is a crucial part of a company's overall financial health.
Yeah.
It impacts their cash flow, their profitability, their ability to grow and invest in the future.
So it's not just a back office function.
No, it's not.
It's a strategic imperative
It is.
that can really give companies an edge.
Exactly. Companies that manage their working capital well can free up cash, improve their profitability, and enhance their financial flexibility.
And that flexibility is crucial in today's uncertain world.
It is. Companies need to be able to adapt quickly to changing conditions, seize opportunities, and weather downturns.
Right.
And good working capital management gives them the agility to do that.
So it's not just about efficiency.
Right.
It's also about resilience and adaptability.
Exactly. And that's why working capital management is so important for investors to understand.
Okay.
It can give you insights into a company's financial health,
Yeah.
how competent their management team is,
Okay.
and their overall competitive position.
So as an investor, what are some key things to look for when you're evaluating a company's working capital management?
Well, one key metric is the cash conversion cycle,
The cash conversion cycle.
or CCC.
CCC.
Okay. And this measures the time it takes a company to convert its investments in inventory and other resources into cash flow from sales.
So a shorter CCC is generally better.
It means the company is turning over its inventory quickly and collecting cash from customers efficiently.
They're generating cash faster,
They are.
which gives them more flexibility.
Right, and makes them less reliant on outside financing.
Okay, so what are some other red flags that investors should watch out for?
Well, here are a few. Growing accounts receivable.
Oh.
If a company's accounts receivable are growing faster than its sales, that could be a sign of loose credit policies or problems with collections.
Okay.
Another one is bloated inventory.
Right. Too much inventory sitting around.
Yeah, it can tie up cash and increase the risk of obsolescence or spoilage.
Okay. And another red flag is extended payment terms.
Right. If a company is constantly delaying payments to its suppliers,
That could mean they're having cash flow problems.
it could, or it could be an attempt to make their cash flow look better than it really is.
Okay, so investors need to pay close attention to those working capital trends
Yeah.
and look for any warning signs.
Absolutely.
All right, well, we've covered a lot of ground with working capital management.
We have.
Now let's move on to financial forecasting and planning.
Okay.
Financial forecasting and planning are essential for companies of all sizes.
Yeah, they are.
They provide a roadmap for achieving the company's financial goals, and they help management make smart decisions about resources, investments, and growth.
Right. It's about looking ahead,
Yeah.
anticipating challenges,
Okay.
and setting realistic targets.
So it's about knowing where you want to go before you figure out how to get there.
Exactly.
And it's an ongoing process, right?
It is. It involves gathering data, analyzing trends, making assumptions about the future, and developing projections.
Okay, well, let's break that down into steps.
Okay.
What's the first step in this whole process?
The first step is to establish clear financial goals.
Okay.
So what does the company want to achieve?
Yeah, in the short term and the long term.
Right, exactly. Those goals might include things like revenue growth,
Okay.
profitability targets, debt reduction.
Or even specific investment plan.
Exactly.
Okay, so you're defining the destination
Yeah.
before you map out the route.
You got it.
All right, so once they have those goals in mind, what's next?
The next step is gathering data. Yeah, so this involves collecting information about the company's historical financial performance,
Okay.
their current market position, and the broader economic environment.
So you're looking at past trends, current conditions, and future expectations.
Exactly. It's about getting a complete picture of the company's financial landscape.
Okay.
And this data can come from all sorts of sources.
Like what?
Internal financial statements, market research reports,
Hmm.
industry publications, government data.
It sounds like a lot to process.
It can be, but there are software tools that can help companies with that. They can
Really?
help them gather, analyze, and visualize all that data.
Okay, so you've gathered all this data. What do you do with it?
The next step is to analyze the data and identify key trends and drivers.
Okay, so you're looking for patterns in that historical data.
Yeah,
You're assessing the company's competitive position.
right.
And trying to understand the factors that might influence their future performance.
Exactly. It's about connecting the dots and figuring out what's really driving those numbers.
And spotting potential risks and opportunities.
You got it.
Okay, and this step often involves some pretty sophisticated analysis, right?
It does things like statistical analysis, financial modeling, and even some qualitative judgment.
So it's a mix of art and science.
It is. Financial forecasting and planning are not just about crunching numbers.
Yeah.
You also need a deep understanding of the company's business, its industry, and the overall economy.
Right. Okay, so you've analyzed the data.
Yeah.
You've identified those key trends and drivers. Now what?
The next step is to develop financial projections.
Projections.
Yeah. So this involves creating forecasts for key financial metrics.
Like what?
Things like revenue expenses, profits, cash flow, and balance sheet items.
Okay, so you're basically creating a financial roadmap for the company,
Exactly.
outlining its expected performance over a specific time period.
Right. And those projections can be developed for different scenarios.
Okay.
Like a best case scenario, a worst case scenario, and most likely scenario.
So they can be prepared for a range of outcomes.
Exactly. And they can adjust their plans if needed.
Flexibility is key.
It is.
Okay, so you've developed those projections.
Yeah.
What's the final step?
The final step is to monitor actual performance against those projections and make adjustments as needed.
So it's a constant cycle.
It's not a one-time thing.
Okay.
It's an ongoing process of planning, monitoring, and adjusting.
It's like steering a ship, right?
Yeah, that's a good analogy.
You have your destination, but you have to adjust your course based on the winds and the currents.
Exactly.
Okay, so we've outlined those key steps in financial forecasting and planning.
Yeah.
Now let's talk about some of the specific techniques that companies use
Okay.
to develop their forecasts.
All right.
What are some of the common approaches?
One common approach is trend analysis, which involves using historical data to project future performance.
So you're looking at past trends
Yeah.
and kind of assuming they'll continue.
Right, but you have to remember that past performance isn't always a good indicator of future results.
Right, things change.
They do. So it's important to consider other factors
Okay.
that might influence the company's performance, like changes in the competitive landscape.
New product launches.
Exactly, or shifts in consumer behavior.
So you need to look beyond just the numbers.
You need to understand the big picture.
Okay, what about other approaches?
Another common one is regression analysis,
Regression analysis.
which uses statistical techniques to identify relationships between different variables,
Okay.
and then uses those relationships to make predictions.
So for example, you might use regression analysis to figure out the relationship between a company's sales and its marketing spending.
Exactly. And then you could use that relationship to project future sales based on different marketing budgets.
Okay, that's pretty cool. What other approaches are there?
Another one is scenario planning.
Scenario planning.
Yeah, which involves developing those financial projections for different potential scenarios.
Okay,
Like a best case scenario,
right.
a worst case scenario,
Right.
and a most likely scenario.
Okay, so you're anticipating a range of possibilities and being prepared to adapt.
Exactly. Scenario planning can help companies develop more flexible financial plans.
Okay, so they're more resilient to those unexpected events.
Right.
Well, that makes sense. So we've talked about trend analysis, regression analysis, and scenario planning. What are some of the biggest challenges that companies face when they're developing these financial forecasts?
Well, one of the biggest challenges is just dealing with uncertainty.
Uncertainty.
Yeah, the future is inherently unpredictable.
Right, you can't predict everything.
You can't.
Okay, so how do companies try to account for that uncertainty in their forecasts?
Well, one way is to build in a margin of error.
A margin of error.
Yeah, so they adjust their projections to reflect the potential for those unexpected events.
Okay, so they're adding a buffer.
Exactly. They're not assuming everything's going to go perfectly according to plan.
Right.
Another way to deal with uncertainty is to use sensitivity analysis.
Sensitivity analysis.
Yeah, which involves testing the impact of different assumptions.
Okay.
on those financial projections.
So like what if raw material costs increase by 10%?
Exactly. Or what if customer demand drops by 5%?
Okay, so sensitivity analysis helps you understand those key assumptions
Yeah.
and how much they could impact the forecast.
Right. And it's an ongoing process.
Mm-hmm.
Companies need to constantly monitor their performance, reassess those assumptions, and adjust their forecasts as needed.
So it's not a set it and forget it kind of thing.
No, it's not. It requires ongoing attention.
Okay, we've talked about the importance of those forecasts, the key steps involved,
Yeah.
and some of the techniques and challenges.
Right.
Now let's switch gears and talk about raising capital.
Okay.
Raising capital is essential for companies that want to grow,
Yeah.
invest in new opportunities, or just fund their day-to-day operations.
Exactly. It's about accessing those financial resources they need to achieve their goals.
So it's like a company's version of going to the bank for a loan
Yeah.
or asking investors for money.
Right. And there are all sorts of ways for companies to raise capital.
Okay, well, let's explore those options.
Yeah.
What are some of the most common ways for companies to raise capital?
One of the most common ways is through debt financing.
Debt financing.
Yeah. Which involves borrowing money from lenders like banks or bond investors.
Okay.
And then repaying that loan with interest over time.
So it's kind of like taking out a mortgage,
Yeah.
but on a much bigger scale.
Exactly. And debt financing can be a pretty cost-effective way for companies to raise capital,
Okay,
especially if interest rates are low.
but it also means they have to make those regular interest payments
Right.
and eventually repay the principal.
Exactly. And if a company takes on too much debt,
Yeah,
it can become financially burdened.
right, and vulnerable to economic downturns or other unexpected events.
Exactly. That's the risk of leverage.
Leverage.
Yeah, it can amplify both the gains and the losses.
So companies need to be careful not to borrow too much.
Yeah, they do. Debt financing is a powerful tool,
Okay.
but it has to be used wisely.
All right, so we've talked about debt financing. What about equity financing?
So equity financing involves selling ownership stakes in the company
Okay.
to investors like venture capitalists, private equity firms, or public market investors.
So instead of borrowing money,
Yeah,
they're selling off a piece of the company.
exactly. And unlike debt financing, equity financing doesn't require those regular interest payments or principal repayments.
So it's a more permanent form of capital.
It is, but it also means that the company's founders and early investors are giving up some control over the business.
Right, because those new equity investors will have a say in how the company is run.
They'll have voting rights and a share of the profits.
Okay, so equity financing is a trade-off.
It is.
They get the capital without the debt,
Right.
but they're giving up some ownership.
Exactly.
All right, well, we've covered debt financing and equity financing. What are some other ways that companies can raise capital?
Another common approach is through hybrid financing.
Hybrid financing.
Yeah, which combines elements of both debt and equity.
Okay, so it's kind of a blend of the two.
Exactly. Hybrid financing instruments like convertible bonds or preferred stock offer investors a combination of fixed income and potential equity upside.
Okay, can you give me an example of how that might work?
Sure, imagine a company issues convertible bonds.
Okay.
These bonds pay a fixed interest rate like regular bonds,
Okay.
but they also give the bondholders the option to convert those bonds into shares of the company's stock.
So if the company does well
Yeah,
and the stock price goes up,
right.
the bondholders can cash in.
They can convert their bonds into shares and participate in that upside.
But if the stock price goes down,
Yeah,
they still have that fixed income investment.
exactly. So convertible bonds offer some downside protection,
Okay.
but they also give them the potential to share in the company's growth.
It's a pretty clever way to structure a financing deal. So we've talked about debt equity and these hybrid instruments. What are some of the factors that companies consider when they're deciding which approach to take?
Well, it really depends on the company's specific situation.
Okay.
There's no one-size-fits-all answer.
Right.
Some of the key factors include the company's stage of development,
Okay.
their financial health, their growth prospects, and the current market conditions.
So a young startup that's growing really fast
Yeah.
might be more likely to look for equity financing from venture capitalists,
Right.
but a more mature company that's already profitable might be more comfortable taking on debt.
Exactly. And market conditions can play a role too.
Yeah.
If interest rates are low,
Debt might look more appealing.
it might. But if the stock market is doing really well, companies might be more inclined to issue equity.
It's about picking the right tool for the job.
Exactly. And it's about understanding the trade-offs involved in each approach.
Right, because every financing decision has implications for the company's capital structure, its risk profile, and its future growth potential.
Absolutely. Raising capital is a strategic decision that needs to be carefully considered and aligned with the company's overall goals.
Well said. All right, so we've explored all those different ways that companies can raise capital.
We have.
Now let's shift gears and talk about valuation.
Okay.
We talked about this a bit earlier when we discussed stock valuation.
Yeah.
But let's broaden the discussion to include the valuation of entire companies.
Sounds good.
So valuation is about figuring out how much something is worth.
Yeah.
Whether it's a stock, a bond, a piece of real estate, or a whole company.
Exactly. It's like getting an appraisal for your house, but on a much grander scale.
Okay, and just like there are different ways to appraise a house,
Right.
there are different methods for valuing companies.
There are.
We talked about some of those methods earlier, like
Okay.
the dividend discount model and the discounted free cash flow model.
Right.
But let's discuss some other approaches that are commonly used.
Okay.
One is comparable company analysis, or comps.
Yeah. Comps.
We touched on that earlier.
We did.
And the idea is you identify publicly traded companies that are similar to the company you're trying to value. And then you compare their valuation multiples.
Exactly. So
Yeah.
you're looking at companies in the same industry with similar business models and financial profiles.
Okay. And you're using those companies as benchmarks to estimate the value of the company you're interested in.
Right. But you have to remember that no two companies are exactly alike. So
Certainly.
you have to adjust those valuation multiples to reflect any differences.
Okay. So you're making sure you're comparing apples to apples.
Exactly. Another common approach is precedent transaction analysis.
Precedent transaction analysis.
Yeah, which involves looking at prices paid for similar companies in past M&A deals.
So you're looking at historical data to see what buyers have been willing to pay.
Exactly. And just like with comps, it's important to adjust those historical prices to reflect current market conditions
Okay.
and any differences between the companies or the deals.
So you're using that historical data as a guide,
Right.
but not as a definitive answer.
Exactly. And then there's discounted cash flow analysis, or DCF. Yeah, which involves projecting the company's future cash flows and then discounting those cash flows back to their present value.
We talked about DCF earlier
We did.
in the context of capital budgeting,
Right.
but it can also be used to value entire companies. So
It can. In fact, DCF is often considered the most rigorous approach to valuation.
okay. But it also requires a lot of assumptions about the future.
It does, which can be tough to predict.
Right.
DCF is really sensitive to the assumptions you make
Yeah.
about the company's growth rate, its profitability, its cost of capital.
So it's important to be realistic and to test those assumptions.
Absolutely. You need to see how sensitive your valuation is to different scenarios.
Okay. And DCF is also more complex and time-consuming than some of those other methods.
It is.
So it's not a quick and easy solution.
No, but for companies that need a really thorough valuation,
Yeah.
DCF can be a valuable tool.
Okay, so we've covered comps, precedent transactions,
Yeah.
and DCF.
Mhm.
What are some other factors that can influence a company's valuation?
Well, a lot of things can impact valuation.
Okay.
Things like macroeconomic conditions.
Okay, like interest rates, inflation, economic growth.
Exactly. Industry trends and competitive dynamics. The company's financial performance, their management team, their brand reputation, even the perceived risk of their business.
It's a lot to consider.
Valuation is not an exact science.
Yeah.
It's a mix of art and science
Okay.
that requires a deep understanding of the company, its industry, and the market.
Well, we've covered a lot of ground in our deep dive into corporate finance.
We have.
We've explored stock valuation, mergers and acquisitions, corporate governance, risk management, capital budgeting, working capital management, how companies raise capital, and the challenges of valuation.
It's been quite a journey.
It has, and hopefully our listeners have a better understanding of what makes the financial world tick.
I hope so.
This is just the beginning of your journey into the world of corporate finance, though.
It is. There's always more to learn.
Always more to learn. So stay curious, keep learning, and don't be afraid to ask questions.
Good advice.
The more you know about corporate finance, the better equipped you'll be to make smart financial decisions.
Absolutely. Whether you're an investor, an entrepreneur, or just someone who wants to understand the modern economy.
That's a great point. Thanks for joining us on this deep dive into corporate finance.
It's been my pleasure.
We'll see you next time for another exciting exploration of the financial world.